Hey there, folks. This is Gabriel Shahin, Certified Financial Planner and President of Falcon Wealth Planning. And today we're going to talk about stocks, just stocks 101. If you're looking to get new into investing and starting up, let's talk about what you should be doing and the things you should be looking at, just the core characteristics. Really, the first one is very simple. It is just be familiar with the company. Know the company you're going to invest in. I'll give you a couple examples. One is Tesla. Everybody knows a Tesla. If you believe in Tesla, you think it's going to be great and be really big long term, that could be a good investment. I'm not telling you to buy it. I'm just giving you an example. And same thing with Apple and Amazon. You know these companies. You know what they do. If you believe in the product, that could be a good investment. Let me give you an example when I was younger. I was looking to invest in Chipotle or cheesecake. Why? Every time I would go there, the lines were long. That is an example of an investment. So I thought of two things. Just logically speaking, I was thinking of a cheesecake factory. I was like, man, I walked in, marble everywhere. There could have been 40 to 50 employees at a time at the Cheesecake Factory. And I'm thinking to myself, man, the menu is yay thick. Man, it probably cost a few $1,000,000 to open one of these up. Then a few days later, I went to Chipotle. The line was out the door, and I'm looking at the menu, and there's like 3 or 4 core things, and you have maybe 10 employees working at a time, and this thing is an assembly line. I thought to myself, what would be a good investment? Sure enough, I said, you know what, Tesla is a good one to choose. Why? Because maybe only 250,000 to open one up at the time. So the point of this is I made an educated decision based on what I thought made sense. So know the company that you're investing in. The second piece of this is the price of the stock. Folks, it doesn't matter what the price of the stock is. It's not a good investment because it's at $20 a share versus $200 a share. That shouldn't matter at all in making a decision of what to invest in, because it's all relative to what's called the market capitalization. What does that mean? How big is the company? The company is worth $10 billion and has 1 million outstanding shares versus a company that has 2 billion outstanding shares that's worth $100 billion. It doesn't matter what the price of the stock is, folks. So don't let that detract you. And if it is trading, whatever the investment may be, at 200 a share, 500 a share, 1,000 a share, you could always buy a fractional share of that as well. And most of the discount brokers that are out there. The last thing I want to talk to you about is just analytics. And no stocks are the same. You can't compare, for example, a Tesla to a Kroger. You get what I'm saying? You can't compare a grocery store to an automotive company, to a tech company, to whatever it may be. So the point is I like looking at the price to earning ratio, because some of these companies that you may be even considering to invest in doesn't have anything there. Why? Because they're losing money. Well, how's the company worth anything? Well, the company's worth something based on what they're expected to make. So when you have an actual number here that is a price earning ratio, let's just call it a 50. That means the company is trading at 50 times what they are making. What does the price mean? The price is the stock price. The earning is what they make. Let me give you an example. If you make $1 million and the company's valued at, for example, $20 million, it is a just simplistic way of explaining it, at 20 times earnings. It is worth 20 times what you make in 1 year. So if somebody offered you $20 million for a company you're making $1 million a year on, you might take it because it's worth 20 times. So the reason you can't fully compare is because of the growth trajectory. That is extremely important. So it is important to compare just what other sectors of that industry is doing for what the price to earnings ratio is. Look at competitors. It can make a lot of sense. These 3 core elements, especially if you have a good price to earnings ratio, especially if it's positive, especially if you feel and you see and you're being told that there is a high growth trajectory, it could be a good investment just to dabble your feet in. Now, with all that being said, the reason I recommended this versus the actual recommendation, which is just indexes. I probably would just tell you to invest in the S&P 500, but you're not going to appreciate that advice until you chip your teeth on choosing stock. Folks, professionals can't even choose stocks. They get it wrong. Even Warren Buffett says it himself. He can't even choose stocks on a consistent basis. And if you're here trying to time the market or day trade, talking about all those people that did great in 2020, 2021, talk to them in 2022. They're crying like a puppy dog. What's my point? Long term, after you chip your teeth and getting experience in the stock market, go to the indices. The S&P 500 averages over 10% return since 1926. This could make a lot of sense long term for you. To appreciate that advice, go ahead and try investing in stock. History shows, academia shows, for every 1 you get right, you get 5 wrong. Don't want to discourage you, but it's a fantastic way to learn. If you have any questions, want some help, please feel free to reach out to us below.